So one of the most important lessons I've learned on my journey to becoming a successful trader is the understanding of the relationship between institutional investors, brokers, and retail investors. And it really boils down to the business model that these brokers have. So if brokers have, say, 4 or 5 really large institutional clients, it is in their incentive to look after those clients, given that the amount of fees they will get from these large trades is a substantial portion of their business. So in order to maintain these clients, they need to keep them happy. And how do they keep them happy? They execute their trades in the most effective and efficient way possible. Often this can occur at the expense of retail traders because retail traders don't understand the business model. So as a retail trader, once you understand the business model, you can start to understand why price moves the way it does, why charts give us certain price patterns and certain price characteristics. Then you can start to use that to your advantage in order to become a consistently profitable trader. So let's get into details of this, and you can have a much better understanding of how you can position yourself on the right side of the brokers and institutional orders so you can become a more consistently profitable trader. So at the end of the day, in most instances, the market is moving because of institutional order flow. When you see a big consolidation in price, it's usually got to do with an institution either offloading or taking on a certain position. So before we get started, you need to understand one very foundational principle of trading, and that is it is a zero-sum game. So what that means is for every buy order, there needs to be a seller, and for every sell order, there needs to be a buyer. And in order to get those buyers and sellers, we have what's called brokers. So these are the 3 main players in the trading game. You have the brokers, which are the intermediary between the buyers and sellers, also known as market makers, and they are incentivized by fees. So their profits come from creating these transactions between buyers and sellers. And you also have institutional traders, which are basically people trading on behalf of an institution. These institutions can be banks, governments, multinational corporations, whatever they are, but generally speaking, they are trading large order sizes. They're not trading $1,000 here or there. They are trading in the millions. And on the other side, we have retail traders. These are just individuals trading a personal account, usually smaller account sizes and generally smaller order sizes, a couple $100 or a couple $1,000 here or there. So a problem these institutional traders have is that when they're trading these huge lot sizes, they require liquidity to get those orders filled. So they can't just go into the market and say, okay, I'm going to put in an order for $500 million and click execute and wait for that to be filled, because there'll be huge amounts of slippage. So even on a 1% of that $500 million order, that's $5 million. And if they continue to do that trade after trade, they're looking at huge losses over the year as a result of slippage. So they want to minimize their slippage as much as possible and gain as much liquidity at the right level or at their order level before moving the market. So for those of you that don't know, this is a very simple example of what the order book looks like. So any broker would have their order book, and you would see, for instance, the euro US dollar, you would have offers at these levels. This is obviously a very broad example. I'm using very wide ranges, but that's just to give you an understanding of how this all works. So you would have offers at, say, 1.24056 for 10 million, which is this order here, all the way up to another 10 million offered at 12564. So an institutional investor would come in and say, I want to place a buy order for 100 million at the current level. Imagine that the current level was sitting at 124. So this is your best offer at the moment is 10 million at 124. So an institutional trader comes in, or an institutional investor says, I want to buy 100 million. And if he were to just put this order in at the market, in order to fill this order, you would have to start by taking the 10 million at 124, and then have to take the 15 at 12438, then take the 5 that's sitting at 12471, the 40 that's sitting at 1250, the 20 million that's sitting at 1253, and finally the 10 million that's sitting at 1256. So although he executed his order at 12405, he only got completely filled at 12568. So there's a huge amount of slippage in that trade all the way up before it gets filled at his final level at 125. And that's a huge amount of losses that the institutional trader has taken, which the broker wants to help him mitigate. So the broker steps in and says, let us help you fill this order. And we'll get you as best as possible, we'll get you filled at 12405. So in order to execute these large trades, institutional traders need brokers to fill large orders for them discreetly and with minimal slippage. And this is where the brokers come in. So these brokers have both retail and large institutions as clients. And as institutions execute the much larger trades than retail, the fees they receive from them are much larger. So they are incentivized to keep the institutional clients happy. And that often comes at the expense of the retail clients. Brokers keep institutional clients happy by filling orders at the best possible level and avoiding slippage. So as an institutional client, if you can find a broker that executes your trades for you at the best possible level, you'd want to keep that broker. That's the other side of the relationship. And these brokers want to keep these relationships going with these institutional investors because they are receiving huge amounts of fees from these big orders. So how exactly do brokers avoid slippage when executing large orders? That's the big question here. Well, they do so by engineering liquidity. So as we said, for every buy order, there needs to be a seller, and for every sell order, there needs to be a buyer. So if an institution comes in and wants to execute a big long trade, they require short liquidity, i.e. they require sellers. And the same, if they want to come in and execute a short trade, they require long liquidity, i.e. they require buyers. So if they want to sell something, they need buyers. So they always need someone on the other side of the trade. So where does that liquidity come from? Well, it comes from retail investors. So institutional investors and brokers take advantage of what's called liquidity pools in order to do this. So liquidity pools are basically just areas where there are likely to be a lot of retail investor stop loss orders and or limit orders. These orders are sources of untapped liquidity that are available to institutional investors. So basically they just buy or sell orders that are sitting on the chart waiting to be executed. So these brokers engineer the required liquidity by moving price into these areas in order to trigger these orders before moving price in the opposite direction. Keeping in mind that the brokers have access to the order book, so they know exactly where these orders are sitting. They know where there's an accumulation of these buy or sell orders, whether they're stop loss orders or limit orders. And this is what it would look like on a chart. So I'm going to keep this example in play here. I'm going to keep this example so I can best explain to you what exactly the price action looks like around an order like this. So you would see price climbing into this region, and before or after an institution steps in, you might see a little bit of a pullback. So this becomes the beginning of the engineered liquidity. So this won't necessarily have anything to do with a new buy order that comes in. It may just be retail taking profits. It may just be a natural swing in the markets, natural cycle of the markets. But this becomes a point where the brokers step in and say, okay, this is a great opportunity to start engineering some liquidity. And we do have a buy order sitting here for our main client of 100 million. So as most retail investors come in, they see this in the market, and one of two things happens. You have the traders that still believe the market's going to go higher, and they start to put in their buy orders here, because what they want to see is a break of this high and a continuation to the upside to see those profitable trades. And as price starts to move higher, you start to see these buy orders accumulate in this region, and those buy orders all have a stop loss, which will naturally come in this region. So price starts to climb up, and those are the orders that you start to see come into the market. On the other side of the trade, you will have a whole bunch of sell orders. So the traders that believe that this is the end of the high and we had a move lower, and this is just the beginning of a corrective move for the downside, because the next move that's going to come is a move like that, and that's what the move I want to profit off of. So they put a whole bunch of sell orders in here, and their stop loss is obviously going to be in this region. So you now have a whole bunch of sell orders and buy orders accumulated around this little swing in price. So we now have what's called liquidity pools. We have a whole bunch of buy orders in this area, and we have a whole lot of sell orders in this area. So what brokers will do is that they will move markets up into this region, trigger all of these orders, and then start to turn price around to drop it down into this region here where all the stop loss orders are. And this is where they're going to start to accumulate sell orders for their buy order. So there's a whole lot of liquidity sitting in this region, both the sells of the stop losses of the buy orders at the top, as well as the sells that the markets believe, for the traders that believe that the market's going to go lower. So there's a huge amount of sells in this region in both stop loss orders and limit orders that get triggered by the price action. And once that liquidity has been sucked up, you then see price start to move off in the direction as their order has been filled, and they would have received a good average fill in this region from all the retail traders trading within the swing high and low of this price action. So that's a very basic example of what it looks like. I want to jump into the charts now and show you what it looks like in real life and how things play out on a real chart. So a good example of this happened on the Euro US dollar recently on the 25th of September, where we saw the Euro US dollar bottom out at this 116.20 region and gave us quite a nice little rally from that area. So price rallied up towards kind of 117.60, and then we started to see quite a deep pullback in the market. So that little deep pullback started to become the swing area of accumulation for an institutional buy order. So what a lot of retailers would have seen is that, okay, we had a very big bottom out and quite a strong rally. So I suspect what we're going to see is continuation to the upside. So I'm going to put my buy orders here. So automatically we start to see an accumulation of buy orders in this region. And those same buyers are going to put their stop loss below these lows. And as we saw, price just climbed up, took in these buy orders, and from there, what we saw was another dip in price. Didn't quite make it all the way down to these stop losses, but did do enough to get a lot more traders interested in this buy at the top here. So there would be a whole new level of buys, some more liquidity coming into the market in terms of buy orders at the top here. And those same guys who put their buy orders at the top would be putting their sell orders below the lows, or their stop losses below these lows. At the same time, you would have started to see some sell orders accumulating for the traders that believed the euro was going to head down from here. So they would have been putting their sell orders in this region. And more than likely, you would have seen another sell order down in this region. So you have an accumulation of sell orders as well as stop losses in this region. And what happens? Price has a little faint off and then heads up once again, triggering in a whole bunch of buy orders in this region. So you now have these buy orders that have been triggered and these buy orders that have been triggered with these stop losses below these lows. And you still have a bunch of sell orders in this region for the markets or the traders that believe that this market is still heading lower. Because in this time, you had a lot of bearish fundamental news coming out that was very weak for the euro and would have expected to see a much weaker euro. And what do we see from this level? A nice big dip. Keeping in mind that there's probably a bunch of buy orders in here that also would have been triggered. And we see price kind of mess around in this region. And with that, you would have seen some more sell orders coming in here. So what you have, what looks like a peak, a big move down, and a little bit of a corrective structure. So you're putting in a whole lot of sell orders here for the traders that believe we're going to see a move lower in these markets. Some more buy orders up here getting triggered. Lots of liquidity being bought, and again, stop losses for those trades are being placed in this region. So as you can see, a whole lot of swing trade action going on here, creating a whole lot of liquidity. We have lots of stop loss orders and sell orders here, lots of buy orders getting triggered. We have lots of sell orders in this region for the guys that believe this is a bearish market, and we have a lot of buy orders that have been triggered that have corresponding stop loss orders in this region. So what we have here is a big liquidity pool of sell orders that any institutional buyer could suck up at this low level instead of having to buy all the way up like in our previous example. So what happens? Brokers take the price and they take a nice big dip back into the liquidity pool. And as you can see, a whole bunch of liquidity getting sucked up, lots of sell orders getting triggered, and the buy liquidity being created. And following that little suck up of liquidity, we see a very nice rally up into the highs. So that's a perfect example of engineered liquidity. You're taking a whole bunch of buyers, sucking them in with these swing moves. At the same time, you're creating a whole lot of sell orders at the lows for the bearish participants in the market. You take price up, all this buy liquidity gets triggered, and then all of a sudden price drops down into the sell orders, into the stop loss orders, sucks up a whole bunch of liquidity, and then we see a strong rally in the euro off those lows. And this happens on all time frames. Keep in mind, this is just a 1 hour time frame. I'm going to take you back to the 8 hour time frame, and we can see what happened on the higher time frame for this to be the same thing. So I'm just going to get rid of everything on the chart, and I'll show you using the bar replay tool how this all played out on the higher time frame as well, and why I am such a euro bull at the moment. So for those of you that follow me on Twitter, you'll know that I'm a big euro bull at the moment. So zooming in, you'll see what's happened. We had a very strong rally up into the region, and we started to see some corrective price action. Straight away, you would have had some participants placing their buy orders up at the top here. And you would have seen those corresponding sell orders or stop losses being placed here. So you see a big move down, big move up. And that would have triggered a whole lot of buy orders. Let's just use the right colors. Buy orders at the top with corresponding stop loss orders below the lows. Then you saw quite a big strong dip. And that would have been a nice corrective move for any more buy orders to come in at the top here to suck in even more long liquidity. And of course, those stop losses are coming below these lows. See another little dip down. All these dips, nice little potential topping pattern, is creating a whole bunch of sell orders in this area. So the guys that are bearish are starting to place their sell orders at these swing lows, believing we're going to see a turn in the market. And once again, we have buy orders up at the highs for the guys that believe we are heading higher. So again, some more buy orders triggered, and stop losses below these lows. Doesn't quite get down there. Maybe it does enough to trigger, but it does give a lot of hope for these guys at the lows, and it also creates an opportunity for any bearish participants to enter their sell orders here, given that what you're looking at is a fairly good example of a nice little head and shoulders that's being developed at the moment. So you're going to see a lot of sell orders in this region. So what we have here is a nice little liquidity pool of sell orders to be sucked up by any big institutional orders that wants to get into the long. So big institutions that want to buy in this area are very happy to see this liquidity pool here. And what happens? We see a nice big dip all the way into this liquidity pool to suck up any liquidity that's sitting in this region for the buy. And then we start to see that move higher. And as you know, on the lower time frames, what we saw was that same little trick to get even more sell orders on the lower time frames so that that liquidity could be bought up for more upside. And keeping in mind what you're looking at here from a classical charting point of view or from any educational point of view that the brokers usually tell you is that you should be looking for these head and shoulders patterns plus a retest. So how many people have now been putting their sell orders here because of this little head and shoulders pattern? So there's a ton of sell orders sitting in this region trading this head and shoulders. It goes up, tricks everybody out, sucks down all the liquidity here from the people that believe that you're trading a head and shoulders with a retest of the neckline has all been sucked in, and you now have a move higher. And what you're seeing is a continuation of that move and a nice big bull flag or bull candle for continuation to the upside. So this is exactly how liquidity is engineered, especially after such a big move higher. And what do we expect moving forward? For those of you that follow me, you know what I'm looking for is a continuation with a minimum target of 124. So expect the euro just to continue moving higher all the way up to this 124 region, potentially as high as 128. So that's engineering liquidity. Now you need to know that not every swing high and swing low is an engineering liquidity event. There are just natural swings in the market, but when you can understand price structure and you can understand how these markets move and how price structure comes into play, then you can really bring all of this into your trading strategy and you really start to be on the right side of these trades rather than being the ones that get fooled by these moves to the downside. So this is exactly why when you look at these markets and you place your orders, it feels like your stops are being hunted. It feels almost personal, like they're watching your orders and coming down to trigger your stop losses after you've entered on the highs. It feels personal because all the other retailers are doing exactly the same thing as you. I know that feeling because I've done this before many, many times. But now that I understand price structure, I understand institutional order flow, I know where I should be, where my orders should be. So now that you understand institutional order flow, you understand why so many retail traders lose money. And you may understand why it feels like when you're getting stop hunted, why it feels so personal, because you're on the same side as all these other retail traders. But now that you understand this, you can also start to see how to be on the other side of that, how to ride on the back of institutional traders and ride that wave all the way to the bank. That's how you become a consistently profitable trader. And when you can tie this knowledge in with your knowledge of price structure, with the nuances of price structure, you are well on your way to becoming a consistently profitable trader. You're well on your way to becoming a successful trader. So I hope that was useful, I hope that was valuable to your trading journey. Thanks for watching, I really appreciate it. Stay nimble, see you soon.